the gold and silver markets and the attacks on the LBMA through gold and silver markets, thanks to Scott Bessent, when you look at all of that, and then you think Iran, and what's Iran's big weapon? It's not the thousands of ballistic missiles they have. It's their threat to shut the Strait of Hormuz. We gold and silver bugs have been making this argument for 30 years. When I watch people only do this from a perspective of gold and silver and nothing else matters, you don't think the oil markets matter. You don't think the currency markets matter. You don't think the bond markets matter. You don't think bond spreads. All that does is that just puts the top end price of gold at the end of this much higher than it was before. If the Fed has to expand the balance sheet to back to $7.5, $8 trillion, well, then gold has to go to $15,000 or $18,000 as opposed to $12 or $10 or $12,000. The oil being sold outside of normal markets, all of that stuff. That's funding all of the global chaos. The global chaos gets insured through Lloyd's of London. Lloyd's of London makes an awful lot of money while the U.S. Navy has to bear all the risks. And don't get me wrong, folks. If you don't get this, I get it. It took me 20 years to figure this shit out. And I dedicated my life to it. It's go time. Okay, because if you look at everything else Trump is doing, attacking the cartels in Mexico, all the deportations, going after the Somali Leering Center mafia up in Minnesota, Venezuela, all of this stuff. And then the gold and silver markets and the attacks on the LBMA through gold and silver markets, thanks to Scott Bessent. When you look at all of that, and then you think Iran, and what's Iran's big weapon? It's not the thousands of ballistic missiles they have. It's their threat to shut the Strait of Hormuz. That's their sanction option. That's their nuclear option. And me personally, I think that the IRGC at the last moment, because all of that pressure points to London and Trump's war with London over control of the pricing of strategic assets around the world, gold, silver, copper, aluminum, oil, this, that, all of this stuff is all still the pricing control of that and the flow control of that from a money perspective also runs through London. It's all backed by Lloyd's of London and all the shipping insurance companies and all the clearing houses and the Bar Association, the Chamber of Commerce in the United States, and all that stuff. That's all British, okay? Every bit of it. It's not Israeli. It's not French. It's not Italian. It's not Russian. It's not Chinese. It's British. So your conclusion is, and this has been my conclusion for over a year, or at least not longer, which is that the IRGC is nothing more than Britain's devil's legions inside Iran.
The real fight here may not be missiles or sanctions. It may be who controls global price discovery. As Tom Luongo points out here, the battleground isn't just Iran, but the financial plumbing that prices commodities like gold, oil and silver through London's clearing and insurance systems. Roughly 80% of global maritime insurance historically flows through London markets, meaning whoever influences that hub indirectly influences commodity trade itself. Investors rarely hear this part because headlines focus on geopolitics, not pricing infrastructure. But if control of commodity pricing shifts currencies, inflation expectations, and asset valuations move with it. Next, Tom Luongo discusses how financial pressure, not bombs, may be the real leverage being deployed.
And I think that with Trump putting full court pressure all around their illicit funding layer, that the organized crime layer, the child trafficking, the fentanyl, the this, the that, all of this stuff, the oil being sold outside of normal markets, all of that stuff. That's funding all of the global chaos. The global chaos gets insured through Lloyd's of London. Lloyd's of London makes an awful lot of money while the U.S. Navy has to bear all the risks, guaranteeing global shipping. So take that away. Now they are under actual existential threat. Add in the blowback from the Epstein files on Prince Andrew, Peter Mandelson, and everybody else, and you start to see the picture emerge that at some point, Trump says, I'm pushing all in on Iran. I moved 2 full carrier groups in. I put a radar blanket over the entire freaking region. Ain't no false flag happening here, boys. You're not sinking one of our ships and we not know about it. Okay, we're going to bring it all in. We're going to bring all the Star Wars weapons in. We're going to bring it all in, and we're going to negotiate the same way you negotiated with Maduro over in Venezuela. Now, Venezuela, Maduro took the deal. Once Trump could guarantee Maduro's safety, he moved the special forces in, wiped out the Cuban security forces and everybody else that was there holding Maduro hostage, for lack of a better term.
The hidden leverage in global conflict is often financial plumbing, not battlefield power. As Tom Luongo points out here, targeting illicit funding networks and insurance backstops can choke off the economic lifelines that sustain geopolitical chaos. Roughly 90% of global trade moves by sea, and the insurance markets behind that shipping quietly dictate risk pricing across commodities and energy flows. When that structure is pressured, energy traders, shipping firms, and hedge funds all reprice risk simultaneously. Investors should watch this closely because disruptions here ripple straight into oil volatility, inflation expectations, and defense spending narratives. Next, Tom Luongo talks about how regime pressure and negotiated power deals reshape geopolitical outcomes.
Went in, 3 hours, went in, got him, brought him out, exfiltrated him with the USB keys and all the information about the stolen 2020 election and the ledgers and the financial ledgers and everything else. Maduro's out. Maduro's a happy guy. He's alive. His wife is alive. His family's alive, right? The mullahs didn't get that option. They didn't get that option. The IRGC said, no, we're going to war. They chose to go to war. And Trump said, okay, great, we're going to war. And now it's just time to wipe them out because there's no negotiating with these people. And it's a sad thing. They had a choice. That choice was put in front of them, and they chose poorly. We gold and silver bugs have been making this argument for 30 years. But when I watch people only do this from a perspective of gold and silver and nothing else matters, I'm like, you don't think the oil markets matter? You don't think the currency markets matter? You don't think the bond markets matter? You don't think bond spreads are this? I mean, it's all the same thing over and over and over again.
All right, so Tom, sticking with the Trump administration, today,
Sure.
I'm sure you saw this, they facilitated a large gold order between us and Venezuela, about 1,000 kilograms of gold to be shipped to the U.S.
When investors focus only on gold or silver, they often miss the bigger macro machine driving everything. As Tom Luongo points out here, commodity markets don't operate in isolation. They move with oil flows, currency stability, and sovereign bond spreads that anchor global liquidity. For example, the US Treasury market alone sits above $27 trillion, dwarfing commodity markets and often dictating global risk appetite. When tensions rise, money shifts between bonds, energy, and metals simultaneously. Ignoring that connection leads investors to misread volatility as opportunity. Next, Tom Luongo unravels how a surprising gold transaction ties geopolitics directly into currency strategy.
What's your takeaway on that? What's the connection to everything else that's happening here, and maybe even to the currency issue?
Sure. No, the Trump administration clearly wants to add to our stock of physical collateral. They also want to get the money into the hands of the sitting Venezuelan government now under Delcy Rodriguez that can start to rebuild Venezuela for Venezuelans. So, okay, we're going to pay you market price for 1,000 kilograms of gold. Like, it's a big deal. And that then puts that into our collateral stack for us to be able to use to issue gold-backed stablecoins or throw them into the vaults of GLD so that GLD can operate as a fully liquefied currency hedge for people who need to hedge their currency risk with gold, and they use GLD for that. So
I've been expect that to strengthen the dollar.
I expect
all the actions that they're taking. If you take them all.
Yeah, well, what I'm saying is that I'm with Brent Johnson on this. I've been with Brent Johnson on this for a while now, which is that there is no real alternative to the dollar because we just saw what the American military is capable of doing with just 2/9 of our Navy, half of our Air Force.
1,000 kilograms of gold might sound symbolic, but collateral movements often signal deeper currency strategy. As Tom Luongo points out here, adding physical gold to financial collateral stacks can strengthen the credibility behind dollar-linked instruments like ETFs or potential gold-backed liquidity tools. Central banks have been quietly accumulating gold for years, over 1,000 tons in 2022 alone, suggesting a broader shift toward harder reserve assets. For investors, that matters because gold increasingly behaves like a monetary asset, rather than just a commodity hedge. If policymakers reinforce dollar strength with tangible reserves, currency competition tightens globally. Next, Tom Luongo discusses why military power still reinforces the dollar's global dominance.
I remind everybody, said this twice this week on podcast, I'll say it again. The biggest Air Force in the world is the U.S. Air Force. The second largest Air Force in the world is the U.S. Navy. Okay. The third largest Air Force is probably Army Air Cav or whatever. I mean, like, you know what I mean? And then there's everyone else. Okay. We're that far ahead in terms of our ability to project that kind of power. Now, we're not going to get into a war with the Russians over any of this stuff because the Russians are helping us. As you pointed out earlier, Putin just told everybody that he's like on board with what Trump is doing. Yeah, he's got Lavrov out there making noises. That's Lavrov's job. But
Today,
Putin then comes out. Yeah, but then Putin comes out and he says, you know, after Trump takes over the shipping, or basically announces his intention to take over shipping insurance, Putin comes out and says, by the way, we're rethinking our ever
the LNG
reopening any LNG or oil and LNG to Europe.
Yeah.
That's a Trumpian play. And so I told RT the other day, I said, the big winner here is Russia. Russia now has that much more leverage to force a conclusion onto the tracksuit midget and Zelensky, who isn't allowed to.
Well, and if China can't get their energy supply out of the, through the Strait and out of that Middle Eastern area, they're going to go over back to Putin.
Military dominance rarely shows up in earnings reports, but it quietly shapes currency power and commodity markets. As Tom Luongo points out here, the sheer scale of US military projection, where the Air Force and Navy rank as the two largest air forces globally, reinforces the dollar's credibility in global trade. Investors often overlook that energy markets, shipping lanes, and insurance frameworks depend on security guarantees largely provided by the US Navy. When that structure shifts, oil flows, LNG pricing, and even sovereign debt risk premiums adjust quickly. Portfolio risk isn't just about earning cycles, it's about geopolitical power backing the system. Next, Tom Luongo discusses over how energy supply leverage reshapes the geopolitical balance.
And they're going to say, I need more. So if that's the case, I would think also India gets hurt a little bit here.
Yeah, they do. And even Modi is finally going, okay, I've got to call uncle here, because clearly Modi kept trying to do the will they won't they thing. He kept trying to he kept being a guy with a foot on two islands. Right, saying, am I in with London and the Davos crowd, or I am with Trump? And keeps playing that game back and forth because he keeps thinking that India is more powerful and more important than it actually is. Because as far as Trump's concerned, nobody is more powerful, nobody is more important than the United States. And everybody, and I mean everybody, has gotten multiple signals now that no one is willing to cross the United States on these issues at all, with a guy in the White House who is willing to defend America's interest.
The fact that Russia and China are nowhere to be found right now to help Iran is proof it's supporting what you're saying.
It said it that, and we heard this loud and clear with their silence last June.
Global alliances often look solid on television, but real power reveals itself when crises force countries to choose sides. As Tom Luongo points out here, the silence from major powers like Russia and China during key tensions tells investors more than official statements ever will. Energy dependency, trade exposure, and dollar liquidity all shape those decisions, and India sits right in that balancing act between Western markets and emerging alliances. Roughly 40% of India's trade still links closely to Western economies, which quietly limits how far geopolitical independence can go. Markets understand these constraints long before politicians admit them. Next, Tom Luongo unravels what gold's recent surge is signaling about global financial stress.
All right, so gold has moved up, 150% or so since breaking out over 2000 in March of 24. It's often viewed as a thermometer of the global financial situation. What's gold telling us? And is it your expectation that gold's going to continue to march higher, either continually or after the spasm you talked about?
There's going to be, if there's a spasm because everybody goes to ground, everybody's going to go to the dollar. But the euro is rolling over. Oil prices are up. Europe is now dealing with that problem. There's going to be this is the recipe for sovereign debt crisis in Europe. Are people going to get hurt? Yes, they're going to get hurt. The question is, this is a big one. This ties into gold. The question then, when money starts going to ground like that, how coupled is the American economy to the implosion of the sovereign debt markets in Europe? That's the question you should be asking yourself. Then the other question is anybody going to allow that sovereign debt crisis to emerge, or we just going to manage the decline of it?
150% surge in gold isn't just a rally. It's a warning signal flashing across the global financial system. As Tom Luongo points out here, gold often rises when confidence in sovereign debt starts quietly eroding beneath the surface. Europe already carries over $12 trillion in government debt, and rising energy costs combined with slowing growth create the classic conditions for debt stress. Investors should pay attention because sovereign debt instability rarely stays regional. Currency markets and equity liquidity eventually feel the pressure. Gold moving first is often the market's early alarm before broader volatility appears. Next, Tom Luongo discusses why investors may need to prepare for sudden market spasms.
At some point, is there going to be a negotiated settlement between the United States and Europe over this? We don't know. These are all possibilities. So be smart, shop S-smart, get 25% to cash, and wait it out. If there's a spasm, you buy the bottom, and you look like a genius. If there isn't a spasm, you slept well for 4 months. You know what I mean?
Yeah, I think that's good advice.
And then as far as gold is concerned, gold needs to go to 15 gold, silver, and Bitcoin need to go to multiples of where they are long term. I'm now talking 4 to 7 year time horizon, long term, to balance the books of the current asset valuations. Trump wants to hold valuations mostly where they are and allow earnings to catch up. And all that does is that just puts the top end price of gold at the end of this much higher than it was before. If the Fed has to expand the balance sheet to back to $7.5, $8 trillion, well, then gold has to go to $15,000 or $18,000 as opposed to $12 or $10 or $12,000.
Markets rarely move in straight lines, which is why holding cash during uncertain cycles can be more strategic than chasing momentum. As Tom Luongo points out here, the possibility of a sudden liquidity shock means investors should think in terms of optionality, not just asset exposure. The Federal Reserve balance sheet expanded from roughly $4 trillion to nearly $9 trillion during the last crisis cycle, and any renewed expansion could again lift hard assets dramatically. If valuations stay elevated while liquidity grows, gold and alternative stores of value naturally reprice higher over time. Smart investors focus on positioning, not predictions. Next, Tom Luongo talks about how central bank policy could reshape this entire valuation equation.
It all depends on whether or not Davos finally capitulates.
So you don't believe the necessarily the narrative put out about Warsh that he's a complete hawk. There's not going to be any rate cuts. There's going to be no spending. We're going to diminish the balance sheet. You know what I mean? The thesis that the narrative they've been putting out. You don't necessarily buy.
I think he's going to cut rates because we're way above the neutral rate at this point because tariffs have been very, very effective and the trade deals have been very effective. And look, again, I've been one of Jerome Powell's best defenders for years. But at the same time, that was during the time when the Biden administration was trying to destroy the country, trying to destroy our capital markets. And he did his job, which was negotiate, to navigate the substitution of LIBOR to SOFR and handle that transition. That transition is over. SOFR now dominates global dollar markets. No argument, right? So therefore, The United States doesn't necessarily need, especially with the kind of inflation that we're seeing currently.
The market narrative says rates stay high for discipline, but policy reality often moves in the opposite direction. As Tom Luongo points out here, if interest rates sit far above the so-called neutral level, pressure builds for eventual cuts regardless of political messaging. Historically, once real rates move too restrictive, credit markets begin tightening quickly, and policymakers step in before systemic stress spreads. Investors should remember that transitions like the shift from LIBOR to SOFR quietly reshaped global dollar funding markets, concentrating even more power in US financial plumbing. That shift matters far more for liquidity than the headlines about political rhetoric. Next, Tom Luongo discusses why interest rate policy may soon collide with banking system stress.
Do we need 4% or 3.5% on the Fed funds rate? No, we actually need to shore up those regional banks and those smaller banks and those credit unions that took big punches in the mouth during the higher for longer period in order to shore up their balance sheets and begin the process of doing domestic credit stimulus, or whatever you want to call it, to start the virtuous cycle of igniting domestic credit, while at the same time, is it going to help some of the private equity guys that are over leveraged? Yeah. Is it going to help the private loan industry? Yes, it will. Again, at the end of the day, you're not going to get out of this clean. There are no good guys and bad guys here. Okay, like everything Trump has done with Iran has been good for America. Got news for you. It's also good for Israel. And that leaves a bad taste in my mouth, because I don't want to see the Israelis get out clean here for what they did in Gaza at all.
The real vulnerability in this cycle may not be inflation. It may be the fragile state of smaller banks. As Tom Luongo points out here, prolonged higher for longer interest rates have already strained regional banks that rely heavily on commercial loans and local deposits. In the UAE, institutions outside the largest money center banks still provide roughly 40% of small business lending, meaning credit conditions tighten quickly when those banks struggle. If policymakers pivot toward easing, it may be less about stimulating growth and more about stabilizing balance sheets. Investors should watch credit availability closely, because lending cycles drive economic momentum far more than headlines suggest. Next, Tom Luongo unravels how political pressure points are beginning to shift financial power centers.
But what am I going to do? Like, Trump is willing to make the deals necessary to get to the better place. And that if that means either flipping bad guys, which he has done with Maduro and tried to do with Khamenei and failed, he's been trying to flip Zelensky and can't, then if those become intractable nodes, then you have to shift to something else. So he's trying to shift the intractable nodes in the Senate. He hasn't been able to do that yet, but he keeps putting more pressure on them, and at some point they're going to crack. And so watch the markets watch these things this way. Note, how is he putting pressure on Europe? Scott Bessent just went after Ember in Zurich, one of the subsidiaries of Julius Baer. Big Tell went after a big bank in Luxembourg, forced MFS in the mortgage company in Europe, in the city of London. That's in trouble. BlackRock's in trouble. This one's in trouble. That one's in trouble. All those people now get to come to Bessent, to Trump, and go, "We need help. We need help."
Financial pressure rarely appears dramatic on television, but it quietly reshapes global power structures. As Tom Luongo points out here, targeting banks, clearing institutions, and financial intermediaries can force negotiations far faster than political debates ever could. When large institutions in Europe face regulatory or liquidity pressure, the ripple effects move through asset managers, credit markets, and sovereign financing channels. Investors should remember that institutions like BlackRock oversee trillions in assets, meaning even subtle policy shifts can redirect enormous capital flows. Markets often react to these structural pressures long before governments publicly acknowledge them. Next, Tom Luongo discusses how central banking strategy may fundamentally change the role of the Federal Reserve.
And if the old system of we're going to give you a bailout isn't there, I think Kevin Warsh is going to do everything he's said he's going to do, which is finish what Powell started, getting rid of the Fed put under the markets. Move the Fed back to a domestic credit-focused institution to bail out and to not bail out, but to help as the lender of last resort for the domestic paper market while preserving, again, everything I said 2 years ago, and preserving the par value of the offshore dollar. And we have an onshore dollar that trades at a discount to the offshore dollar. If you want dollars overseas, you're going to pay a premium for them, but Americans are going to get them at a better rate. And that is what's going to drive everything I just said about the equity markets towards that eventual conclusion. Again, is this going to happen without volatility? No. Why? The enemy gets the vote. That's why. So watch it play itself out and try not to be a response engine in the moment. Understand as much of what I just told you as you can.
For decades, markets have relied on one quiet assumption. The Federal Reserve will always step in to save them. As Tom Luongo points out here, the idea of removing the Fed put would fundamentally change how investors price risk across equities and credit markets. If the Fed shifts towards supporting domestic credit rather than global asset prices, liquidity could tighten for speculative sectors while strengthening core economic lending. That would reshape everything from tech valuations to private equity leverage strategies that flourished during ultra-low rates. Investors who ignore that structural shift risk, misreading the next market cycle entirely. Next, Tom Luongo talks about why navigating this transition requires patience and long-term thinking.
Don't get me wrong, folks. If you don't get this, I get it. It took me 20 years to figure this shit out. And I dedicated my life to it. So I'm doing my very best to try and give it to you in digestible chunks with receipts in terms of the way the geopolitics works, to then put it all together and go, oh, actually, we are in not safe hands, but the safest hands we can ask for, given the situation. And are we going to get our hair mussed? Yes. Is it going to be hard? Yes. Don't think, I never thought that Trump wasn't going to, after last June, I'm like, Trump's going to attack Iran unless they capitulate. They're not capitulating? Fine.
Complex macro shifts rarely happen overnight, and understanding them often takes years of watching patterns repeat. As Tom Luongo points out here, geopolitical power struggles, financial markets, and central banking policy are deeply connected in ways most headlines never explain. Investors tend to focus on quarterly earnings or daily price moves, yet the forces shaping markets often unfold over decades. Strategic patience becomes essential when navigating periods where political decisions, commodity flows, and monetary policy collide simultaneously. Long-term investors who step back from daily noise usually position themselves far better for structural changes.